Warren Buffett's successors have long been a topic of fascination, not only for the financial world, but for anyone who has studied the psychology of leadership, the fragility of empires, and the timeless laws that govern how great vision is transferred from one generation to the next. People often assume the answer lies in choosing someone who can pick stocks like Buffett, but that is the naive view of the crowd. A true investor knows that the more important succession happens not in investment style, but in philosophy, temperament, and the ability to uphold a culture built over decades of compounding trust. Berkshire Hathaway is not merely a corporation. It is an organism shaped by discipline, decentralization, ethical clarity, and a deep reverence for rationality. To understand who will carry Buffett's torch, you must first understand what the torch actually is. It is not the portfolio. It is not the brand. It is the invisible architecture of decisions, millions of micro-choices accumulated across 60 years that turned a dying textile mill into a financial cathedral. Most people misunderstand succession because they look at the surface indicators, titles, resumes, public appearances. But a seasoned investor reads succession the way one reads a balance sheet, by interpreting the silences, the footnotes, the incentives, the behavior under stress. If you look through that lens, the likely successors emerge not as random executives, but as individuals shaped methodically through years of unseen apprenticeship. Greg Abel, for instance, represents what Buffett calls the man who gets things done. Buffett has praised him repeatedly, not for charisma, but for character. A relentless operator with integrity baked into his decision-making. Todd Combs and Ted Weschler, meanwhile, are more than portfolio managers. They are students of the Berkshire ethos, absorbing the subtle craft of capital allocation, much like a young artisan learns from a master. But here is the deeper truth. No successor can replicate Buffett, because empires built on unique genius cannot be duplicated. They can only be translated. Buffett lived through eras that shaped him in ways the modern world cannot recreate. The 1,940 seconds newspaper stock tables, the teachings of Benjamin Graham, the years of scrounging for cigar butt opportunities, the psychological conditioning of making decisions in obscurity before fame arrived. The world that forged Buffett does not exist anymore. So the real question is not who will be the next Buffett, but who can interpret Berkshire's DNA for a world where algorithms, global capital flows, and real-time information make investing a far more psychological game than it ever was? What separates durable organizations from fragile ones is not whether the successor is as talented as the founder, but whether the founder builds a system that does not require their unique brilliance to survive. And Buffett has spent years constructing precisely such a system: a decentralized operational model, clear capital allocation principles, managers who behave like owners, and a culture that punishes ego while rewarding rationality. To sustain this system, the successor must possess a temperament that is almost monk-like, patient when others panic, humble when others seek attention, disciplined when others crave complexity. Abel, Combs, Weschler, all have displayed fragments of this temperament, yet the public often overlooks another dimension: the psychological burden of inheriting a legend. Imagine stepping into the shoes of a man whose annual letters are studied like scripture, whose quotes circulate like proverbs, whose track record is unmatched in modern financial history. You inherit not only authority but expectation, not only a portfolio but a myth, and myths can suffocate even the most competent leaders. This is why temperament matters more than technical skill. A successor must be immune to the seduction of performing for the crowd. Buffett has always said, "We don't do predictions, we do decisions." The successor must resist the modern investor's addiction to noise, even under immense pressure to appear active, visionary, bold. In truth, much of Berkshire's success came not from action, but from refusal. Refusal to diversify unnecessarily. Refusal to chase hot sectors. Refusal to bend to Wall Street's quarterly rituals. A successor lacking this backbone will not last. But here is where most analyses miss the deeper layer. Succession at Berkshire is not a single baton pass. It is a mosaic of responsibilities. divided among leaders who complement one another. Abel running operations, Combs and Weschler handling investments, the board providing philosophical continuity. This multi-pillar structure reduces the risk of any one individual failing. It mirrors the ancient principle that great kingdoms fall not because of weak kings, but because they concentrate too much power in a single point of failure. Buffett ensured that Berkshire would not be a one-man kingdom. And yet, even the strongest structure can weaken if the culture erodes. Culture is the silent compounding machine behind every enduring empire. Once culture deteriorates, financial metrics follow like shadows. So the question becomes, who among the successors not only understands Berkshire's culture intellectually, but embodies it? Abel's reputation for fairness and operational discipline is one indicator. Combs and Weschler, living modestly, despite managing billions, is another. But beyond the individuals, there remains a timeless truth. The market will test them in a way Buffett has not been tested in decades. Buffett earned his reputation through firestorms, crashes, panics, inflationary collapses. A successor's legitimacy is never inherited. It is forged in crisis. And that crisis will come. It always does. The next torchbearer must face the dragon without the old master at his side. In those moments, the crowd will panic. Analysts will scream. Headlines will declare the end of the Buffett era. And it is there, in that silence between noise and decision, where the true successor reveals himself. But even beyond the mechanics of leadership and crisis, there is a philosophical dimension that only veteran investors understand. Empires like Berkshire do not thrive because of strategy. They thrive because of identity. An investor with weak identity gravitates toward trends. An investor with strong identity gravitates toward principles. Buffett's identity was built on compounding, integrity, rationality, and long-termism. If the successor loses even one of these pillars, the structure will wobble. If he loses two, the temple collapses. That is why understanding the essence of Berkshire is more important than predicting its next moves. Berkshire is not a portfolio. It is a philosophy with a balance sheet. Buffett's successor, therefore, must be not only a steward of capital, but a guardian of philosophy. And that guardianship becomes more challenging as the world accelerates. Modern markets reward speed, algorithms, and quarterly dopamine hits. Berkshire rewards patience, human judgment, and decades-long thinking. This tension will test the successor's soul. Will he bow to the world or bend the world to Berkshire's principles? Only one of those paths carries the torch forward. And if you study the patterns of succession throughout history, from ancient dynasties to corporate empires, you'll notice a recurring truth. Successful successions happen when the heir understands not what the predecessor did, but why he did it. Without that insight, even brilliance becomes dangerous. With that insight, even ordinary talent can compound into greatness. And this brings us to the final question that most observers ignore entirely, yet it determines everything. What truly keeps an empire alive is neither the founder nor the successor, but the invisible thread of philosophy passed from mind to mind, generation to generation, like a flame sheltered from the wind, carried through storms and scarcity, entrusted only to those who respect it deeply enough to preserve it, rather than reshape it for the illusions of modern applause. That is the torch Buffett is passing, a torch that does not burn the hands of the worthy, but consumes the unworthy. And the one who will carry it is not necessarily the one with the loudest title, but the one with the quietest ego, the steadiest heart, and the capacity to hold true to Berkshire's identity, even when the world demands reinvention. For ultimately, the future of Berkshire will not be determined by markets or headlines, but by whether the successor can withstand the immense psychological gravity of replacing a legend without losing himself, without losing the philosophy, without losing the quiet discipline that made Berkshire a sanctuary for rational capital when every other institution was seduced by noise and narrative, and whether he can stand firm in those moments when the crowd trembles, the pressure mounts, and the torch feels unbearably heavy in his hands, as he prepares to take the first step into a future where the world will judge not what Buffett built, but what he chooses to carry forward, with the weight of history pressing against his decisions like an invisible hand, reminding him that greatness is never inherited, but earned through choices that reveal the investor's soul far more than any financial statement ever could. And in that moment, the successor will discover a truth that every seasoned investor learns. Eventually, legacy is not measured by how perfectly one imitates the master, but by how faithfully one preserves the principles that allowed the master to transcend his era. Because the markets will evolve, industries will shift, technological revolutions will rewrite the rules of competitive advantage, and geopolitical tides will reshape global capital flows. Yet the core laws of rational investing remain as timeless as gravity. Buffett did not succeed because he found a secret shortcut. He succeeded because he refused to abandon first principles, even when the world mocked him for it. And that is why the soul of Berkshire cannot be carried by someone who merely understands strategy. It must be carried by someone who understands restraint. For in investing, the hardest action is often the one you never take. And as the successor enters this arena without Buffett's shadow to shield him, he will face the paradox that destroys many leaders: the pressure to prove himself by acting differently, by being bold, by showing his fingerprints on the empire. But the investor who understands the power of compounding knows that unnecessary change is the tax foolish leaders pay for their own insecurity. What Berkshire needs is not a performer but a steward, not a revolutionary but a guardian. Greatness in succession is not about adding new pillars, but about protecting the foundations. And so the true test of Buffett's heir will not come in the form of a brilliant acquisition or a perfectly timed investment, but in the quiet decisions where he chooses not to bend to popular demand, not to chase fads, not to dilute the culture to earn applause from the short-term thinkers who have never built anything that survived a full market cycle. When you study the rise and fall of empires from ancient dynasties to modern corporations, you begin to see a pattern so clear it becomes almost mathematical. Empires collapse not because the successor lacked intelligence, but because the successor lacked the humility to realize that strength lies in preserving what works rather than reinventing what doesn't need to be changed. Buffett has already built the architecture. The torchbearer need only maintain the light. Yet the temptation to leave a mark destroys many heirs. And this is why Buffett has always emphasized temperament above brilliance. A brilliant investor with poor temperament will destroy value at a scale far greater than a mediocre investor with strong temperament can ever create. This principle is as old as commerce itself, and as true today as it was 1,000 years ago. But here is the deeper reality that few analysts dare to admit. The identity of Berkshire's successor matters less than the identity of Berkshire itself, because corporations, like people, develop personalities over time. Some become aggressive, some become fragile, some become addicted to speed, some become patient giants. Berkshire's personality, shaped by Buffett, is one of disciplined patience, rational optimism, decentralized trust, and allergic reaction to unnecessary risk. As long as the successor remains faithful to that personality, Berkshire will continue to grow like an ancient tree, slow, steady, unshakable, while the forest around it burns and regrows in endless cycles of speculative mania and inevitable collapse. Greg Abel, with his operational steadiness, may become the grounding force that keeps Berkshire's culture intact. Todd Combs and Ted Weschler, with their investment acumen shaped quietly under Buffett's long shadow, may become the architects of the next era of compounding. But the true future of Berkshire will emerge from their collective ability to maintain balance. The balance between caution and opportunity, between humility and confidence, between analysis and intuition. For investing is not a science of certainty, but a craft of controlled uncertainty. And the successor who carries the torch must accept that the torch does not illuminate the future, it only illuminates the principles that guide you through the darkness. And in moments of crisis, and there will be many, the world will watch with predatory attention. Critics will sharpen their knives. Investors will whisper that the magic has faded. Analysts will claim to have foreseen Berkshire's decline. But those who understand the rhythm of markets know that crisis is merely the forge where true leadership is revealed. And when the successor remains calm while the world panics, when he acts without haste, when he upholds Berkshire's values, even when those values seem outdated to the impatient masses, that is the moment when the torch truly transfers, not through a board vote, not through a public announcement, but through the crucible of chaos, where character matters more than strategy. Ultimately, the story of Berkshire's succession is not about names or titles. It is about the continuity of philosophy. Buffett's legacy is not his fortune, but his worldview. He taught an entire generation that rationality is a superpower, that patience is a competitive advantage, that integrity compounds just as powerfully as capital. And the one who carries his torch will be the one who understands that wealth is not accumulated through brilliance alone, but through the discipline to remain unchanged by the noise of the world. And so, when the successor finally stands at the helm of Berkshire, what the world will judge is not whether he replicates Buffett's performance, that is impossible, but whether he sustains the principles that allowed Berkshire to become a sanctuary of long-term thinking in a world increasingly addicted to immediacy. If he succeeds, then Berkshire will endure, not because of the man who built it, but because of the men who preserved it. And that is the ultimate torch, a flame of philosophy carried across generations, each steward protecting it not for themselves but for the future, ensuring that what Buffett created does not vanish with time, but becomes a living testament to the power of disciplined thought, rational action, and unwavering integrity in a world that constantly tempts us to abandon all three. And in that quiet realization lies the truth that every great investor eventually learns. The greatest empires are not sustained by brilliance, but by guardianship, not by noise, but by clarity, not by the ambition of the successor, but by his devotion to principles that are far older and far wiser than any single individual, reminding us that the torch of leadership is not a symbol of power, but a burden of responsibility that only the worthy are willing to carry.